All-in yields in investment grade are high against history and kind of notably high against the post-financial crisis and COVID period. As you know, we can decompose the yield that you earn on investment grade into kind of two components. One, the yield from the underlying government bonds, and secondly, the credit spread, so the extra yield you earn from taking corporate credit risk. Now, of those two components, it's the government bond yield that's kind of high, and the credit spread is actually relatively tight. On the spread side, we think a note of caution is warranted. Corporate fundamentals are very strong, but where spreads are, you're almost priced for the perfection and the continuation of those corporate fundamentals. If we have any disappointment in earnings or in the macro environment, we could see spreads widen a little bit. We think, when we think about an all-in yield of a credit fund or how we position in credit, we would kind of recommend that allocations are not too overweight in credit, and that credit betas within credit funds are not too long. So credit spreads do reflect the current strong fundamentals, but because we don't have a real cushion for anything going wrong, we would advise a little bit of caution on taking too much credit risks in portfolios at the moment. And indeed, investors may want to consider upping their credit quality as they look at credit markets. Broadly, the cuts that central banks have done do make duration more attractive. Now, it may well be, as we go through 2025, if we get further cuts, that yield curves steepen. So the front end yields fall as central banks carry out their cutting programs, but that 10 years and longer don't really fall because markets are worried about fiscal deficits, and so they price in a term premium. However, even then, it's still broadly supportive for duration. Over the last couple of years, investors have been able to earn very good yields from cash rates. As those are lowered, extending out the curve and taking a bit more duration risk to lock in the yields on offer is probably going to look like an attractive thing to do, in our view. So we don't really see a potential materially wider credit spread environment. And the reason, at least in the short run, and the reason for that is that corporate fundamentals are currently very, very strong. Corporate leverage is at 10-year lows in both the US and in Europe. And globally, bank capital is at all-time highs, and asset quality is forecast to go sideways at low levels. What could cause spreads to widen, of course, is a recession, and alongside that recession, materially falling corporate earnings. Now, in a recessionary environment, we'd expect IG spreads to be closer to the high 100s rather than inside 100 over govies that we see today. But we don't forecast that recession picture to play out. And even if it does, corporates currently have a significant amount of flexibility on what they would do in such an environment. The overall yield for investment grade, is attractive currently, around in the mid fours for global IG, but in the sort of like mid to high fives if you look at long end. That kind of all-in yield compares relatively well with, for instance, long-run return on equity markets of 7 to 8%. So if we can get in the 5% return for investment grade bonds, which are at the top of the capital structure and much less volatile than equity markets, that's something that compares relatively well. Although we're slightly cautious in the short run on taking spread risk because we start at very tight levels, over the long term, over a holding period, we do think investors will earn that extra spread, will earn excess returns over and above governments. And so the combination of earning the excess return from an asset class that's in a fundamentally very strong place and where the all-in yield compares historically with equity returns is quite a nice environment for investors to continue to hold credit and continue to allocate towards it.